Hi, I'm Roger Montgomery and welcome to this week's Video Insight. Well, it's easy to get distracted by all of the announcements made during reporting season, but one theme I'm always reminded of is the long-term outperformance of founder-led companies. And when, for example, ARB, Reece, WiseTech and Macquarie Technology report their full-year results, I also remember the people behind these businesses are still driving strategy and ignoring the noise associated with the market and analysts' short-sighted demands. That the bulk of their personal wealth is also tied to the outcome of their efforts is reason enough to keep a close eye on the companies whose share registers are dominated by founders, their families and friends. As an investor, what gives me plenty of comfort is the copious research justifying that sense of well-being. Wouldn't you be comfortable with the circa 10-year share price returns for ARB of 220%, or Reece of 310%, WiseTech 2,685%, and Macquarie Technology of almost 1,800%? Backing the argument to focus your investment efforts on founder-led listed companies is one of the most comprehensive studies on the subject by Credit Suisse. The CS Family 1000 report examines 1,000 publicly traded companies where the founder or founding family still have significant influence. And that report found that founder-led companies outperform the broader equity market by approximately 4.5% annually over the long term. In another study by Bessemer Venture Partners, they looked at the performance of companies in the Russell 3000 index for the 20 years between 1998 and 2018 and found that founder-led companies generated returns of 10.1% per year compared to 7.2% for non-founder-led companies. And finally, Bain & Co.'s founder mentality framework has revealed companies that maintain founder-like qualities achieve higher revenue growth and superior shareholder returns. I think you can build a pretty resilient all-weather portfolio by finding founder-led businesses that also meet the quality criteria we've talked about here at Montgomery for more than a decade. Founder-led firms tend to be more focused on innovation and long-term strategy. They often have a strong company culture rooted in the founder's vision, and they take more calculated risks. They can also be more disruptive and insurgent and almost always focus on long-term growth rather than short-termism. And whether it's America's Bezos, Gates, Jobs, Zuckerberg or Musk, or in Australia the Tudehopes at Macquarie Technology, the Browns at ARB, the Wilsons at Reece, or Richard White at WiseTech, one of the most significant and observable advantages of founder-led companies is the alignment of leadership with long-term shareholder value. By contrast, hired professional CEOs, while often highly capable, no doubt about that, and motivated to make money, can lack the same level of personal investment in the company's success. Their career plans and corporate ladder scaling dreams ensure compensation is frequently tied to shorter-term performance metrics, which may not be in the best interests of the company's long-term health. Perhaps Qantas comes to mind as a recent example. There's a business now left with some damage to its brand, but most certainly a multi-billion-dollar bill for replacing an ageing fleet of planes. I think with their significant equity stakes, founders are more likely to prioritise sustainable growth, innovation and long-term strategic planning. They're not going to waste money on brand building advertising follies. They'd prefer to spend money on calls to action. Another critical factor setting founder-led companies apart is their ability to build and maintain a strong company culture and greater resilience in the face of adversity. One's reminded of Elon Musk sleeping on the factory floor at Tesla for 3 years when times were tough and the company almost went broke. This resilience often stems from the founder's personal attachment to the company's success and their very reputation. When times are tough, founders are more likely to double down. Now, I've seen this multiple times. There's an often ignored ratio in business called asset turnover. The ratio compares the company's gross revenue to the average total number of assets, and it reveals how many sales were generated from every dollar of company assets. Now, when founders spend money on R&D, research and development, or invest in assets for long-term revenue creation, the ratio plummets. And almost predictably, every time, impatient analysts become nervous, causing the share prices to plunge. When you see this occur, especially to a reputable founder-led company with a long-term vision and great quality metrics like high rates of return on equity and little or no debt, it's time to ignore the market and take advantage of its short-termism. The bottom line is this: founder-led businesses should represent a meaningful part of your portfolio. That's all we've got time for today. Thanks for joining us this week, and we look forward to talking with you again next week. In the meantime, please continue to follow us on Facebook and X.